welcome to the Beryl Consulting Group's 2024 Recap Part 2. I'm Jessy Wang, and this is a continuation of our 2024 analysis. Let's explore the first set of key charts and their implications. The first chart is about US inflation and trajectory. The inflation rose from 2.4% in September to 2.7% in November. The upcoming inflation data for December, set to release on January 15th, will be pivotal for shaping 2025 expectations. The second chart is about the 10-year Treasury yield. As of January 6, the 10-year Treasury yield has reached 4.7%, its highest level in 8 months. This reflects market concerns over persistent inflation and expectations of robust economic growth, marking a sharp rise from 3.7% in September. Shifting focus to U.S. federal debt, this chart illustrates its staggering climb to a record of $36.2 trillion, up to $14 trillion in just 5 years. That's over 120% of US GDP, one of the highest debt-to-GDP ratios on record. Such levels raise grave concerns about fiscal sustainability and its potential implications for interest rates and economic growth. The next chart is about US budget deficit. Over the last 10 years, US federal government tax revenue has increased 60%, while government spending has increased 99%. A question for us to think about is, does the US need higher taxes or less spending to balance the $2.1 trillion budget deficit? The next chart is about the S&P 500 valuations. We briefly mentioned crocodile mouth, the technical jargon, in our previous 2024 market recap short. The S&P 500's price-to-earnings ratio stands at 22.5, with only 2 historical precedents, the dot-com bubble and the COVID QE bubble. Such valuations underscore the risks for growth-focused investors and sustainability of the current equities bull market. Now let's pose on the following 2 questions. How might persistent inflation and escalating federal debt shape monetary policy and market dynamics in 2025? Do stretched equity valuation indicate the market correction is overdue, or could strong economic growth sustain current levels? In Part 3, we will tackle challenges in real estate and tech valuations, along with more pressing economic issues. Stay tuned.